Okay, it's now noon, so let's get started. Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre, and welcome to the 2026 Apple Outlook webinar. Before we get started today, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be a time for questions and answers at the end of the presentation. Questions can be submitted at any point using the question mark screen. This will expand a text box for you to type in your question. And then lastly, a recording of today's webinar and presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And a quick disclaimer, this information is presented in good faith and is not intended for investment, tax, or legal advice. I'll now hand it over to my colleague Kyler to introduce our speaker today.
Hello, everyone. My name is Kyler Reynolds. I'm with Crop Growers and Farm Credit East. Thank you all for being on the webinar today. I'm pleased to introduce Chris Gerlach, the Vice President of Insights and Analytics at USApple. Chris, I think you're muted.
And you're still muted, but your PowerPoint looked good.
We're going to go back to share. Sorry about this, folks. Okay, we good? You can hear me and
we
see
still
me?
see. Okay, there we go. Yep,
Okay.
Perfect.
Beautiful. All right. Well, thank you, Farm Credit East for having me. Appreciate this platform to talk about some higher level issues every year. Thanks for the folks on the line joining us. Got a lot to cover, so we're going to jump right in. As we said, this presentation is available through Farm Credit East, and I'm always happy to share the slides. So don't worry about if we go too fast over anything. We're going to start with some production trends, look at some storages, movement trends, trade trends, sort of catch us up to where we are. Then we're going to go into the white paper that I wrote, talking about looking historically at inflection points and trying to work backwards into sort of what our demand needs to be or is, and what our prices are going to be with that. And then we'll end up with some prices and return trends, just to wrap things up. So as a reminder, USDA puts out its production forecast every year. And if you ask them, 282 million bushels in the 2014-2015 season was the top. But of course, we know they stopped tracking a bunch of states in 2017, 2018. And so USApple, I do estimate the production out of those states, and find that the 23-24 season is likely our top producing season ever. Adding those back into the USDA sample. Last year, USDA, again, with my other additions, ended up around 275 million bushels. By volume, that's about 70-30, with a little bit not sold. By value, the not sold don't have value, so it's about 90-10 on about $3 billion of valuation there. So that's the utilization. So in terms of bearing acreage, what's been going on between 2012 and 2022, we added 10% more bearing acreage in the top 7 Apple states that we have data for. That's about 26,000 acres. And fortunately, some of that growth has abated. We're down between 2022 and 2024 about 3,000 acres, but actually during that period, Washington still grew about 1,000 acres. So any acreage removal has not shown up in the data yet, as far as I know. But in May, on May 12th, USDA will be putting out the final revised estimates for the production, utilization, and acreage for the 25-26 year. So we'll be eagerly awaiting that data, and then doing another webinar to look at how that all played out. By variety, so this is from the annual report last year. You've got Gala #1, Red Delicious, Honeys, Granny, Fuji, Cosmic up there in the top 6. Golden, Pinks, and then all the others. So all those others, the highlighted ones, Rome's, Ida's, Ida Reds, Yorks, Cortlands, those are all the processing varieties. So for the most part, we are dominated by the fresh varieties, and getting more so with each passing year, and older trees coming out, newer trees coming in. So in terms of who's growing and who's shrinking, I have Honeycrisp, Grannies, Cosmics, and Pinks in the sort of growth bucket. Reds, Goldens, other varieties kind of bopping up and down, staying. Reds were declining for a number of years. I moved them from the declining to sort of steady now with the last couple seasons, as that decline has slowed. Golden's still kind of holding on. Others, again, those are all those club varieties and processing varieties. Galas I put in the down category this year. It is trending in that direction, but still the #1 apple, huge volume. Expect that to continue for some time. Fuji's down a little bit, and then again the Rome's as an example of the processors on the way out. In August every year, again we're meeting in Chicago right around the time of the USDA forecast to try and adjust that number. Adding my other state production into that, we had USDA's estimated around 290 million bushels. This August we met and revised that down to 279. That is made up of Washington, the big state there with 180 million bushels. In terms of we saw from their November to December figures, we saw a significant reallocation of fresh to processing, around significant for most other states, about 5 million bushels that they had initially thought were going to go towards fresh, that they sort of realized that due to lower pack out issues, due to heat stress or whatever it was, that they thought they were going to have around 5 million bushels less. So they've adjusted their crop number lower. New York, 31 million bushels. Michigan, we had them at 30 million bushels. We actually took that estimate up from what USDA was saying. And then when we got the December figures in for the storage report, Michigan was under about 24%. So that 30 million bushels likely too high. Pennsylvania, 11 million. Oregon, 4. California, 4. Virginia, 3 million. They were hit hard. Their December storage volumes were about 30% under from last year. And we've heard they've already gotten some weather this year, some early frost. So fingers crossed they make it out okay this year. Other states, 17 million bushels. So again, important not to lose sight of these other apples, that whether they're direct to consumer or commercial, they are competing with these other states and should be quantified and added into the mix. So how are we ending up on the storage? We started 133 million fresh, up 2% year over year, and we've accelerated movement. By April, we're down to 60 million bushels, down 9% year over year. On the processing side, we started with 52. We're at 29 right now. And so we're decelerating there. We started 12% over, and now we're slipping to 4% over, which maybe we're just hoarding them. Honeycrisps, 52%. We've got 12 million left, 52% year over year. So a lot of those are processing. Again, Washington recategorized a number, basically 1 pack per bin on what was going to go to fresh versus processing. So we've got significantly more processing Honeycrisps than we did last year. Grannies are 12 million bushels, up 13%. Cosmics, 11 million bushels, up 7. Gala's 10, down 22. Reds 10, down 21. Pinks were at 7, down 17. So Washington is holding 75 million of the remaining apples. So the vast majority they're a little bit down year over year. New York's got 8 million bushels left, a little bit above last year. Michigan's down, so they've slowed their roll. As I said, in December they were down 24% or something. They're only down 9 now, so they're rationing their apples, I guess. 2 million bushels in Pennsylvania, up 17% year over year. How are we doing on movement this year? Well, we had our best November ever. Compared to November 2014, we moved 18.3 million bushels through the AMS data set. So it's good enough for the top month of movement ever as of and these data are as of March. U.S. fresh apple exports. Here we have the 5-year average in gray, last season in yellow, and this season in red. As you say, we're well above the 5-year averages for exports, trending about 4 million bushels more season to date than the 5-year average, and 1 million bushels more than season to date for last season. So good. Keep your foot on the gas, and I guess send them everything but Honeycrisp. U.S. fresh apple exports. Here we have Mexico as our #1 trading partner, 30%, worth about 385 million. Canada is their second at 164 million, 17%. Taiwan, #3. India, #4, back up to #4. Vietnam, and so what's important to note, we're certainly with the USMCA renegotiation, we don't want to lose Mexico and Canada. We've got some other opportunities in India and Taiwan. We've heard whispers about. We don't quite know the details yet, but when you're looking at a market like India, volume is great, but value is also very important. And so, when you're talking about the potential beneficial trade from growing Taiwan versus in India, you've got 20, 26, $27 a box versus 18, $19 a box. So these India prices are very much promotional pricing meant to reopen this market after having lost it in 2018. We'll talk about that more. But certainly important to keep that in mind, and it could obviously be also the types of apples that are going there, bringing that price down. Deep bench, we got 55 other trading companies worth trading countries worth 333 million. So important to, as I said, keep that going. This, when we're talking about rhetoric, when we're talking about Canada being the 51st state, we did see a hit to the exports, about $6 million worth of in early 2025. But fortunately, Canada had maybe a bit of a short season, bit of a short memory, and sales to Canada are back and above where they would have been. So you see the 25, late season 25, we were outperforming year over year. So things seem to be going well in Canada, and fingers crossed we hold on to that market with the free trade. In terms of consumption, this comes from Category Partners Nielsen data, and this is volume change and price change. So volume, apples over 5 years are down about 1%. Who's doing well? Well, it's the berries are doing well. They're year-round now and competing against apples. And who's not doing so well? The peaches, cherries, pears, apples. These are unfortunate given a lot of the apple growers are growing these other products as well. So as we mentioned, apples down on 5-year consumption, about 1%, worth 2.3. That sector being valued at 2.3 billion. But applesauce, apple juice, hard cider, apple cider, we're all down. Everything except dried apples. So definitely important to keep our attention focused on putting out health messaging that increases the consumption of both fresh and apple products. Again, this is other analysis. This is sort of a pitch for why you need to be or why you should be at our annual Outlook conference in August. Apart from us coming together and coming up with that estimate, we've got great data like this that that's hard to get elsewhere. We lost the sub-processing data from USDA, and so this is a great place to touch base with these other processing categories and to learn a little bit about how elasticities differ both by variety and by retailer. So, the extent to which a retailer can move more volume through price changes depends on the retailer and the variety. So, interesting stuff there. We've heard a lot about fertilizer pricing and gasoline pricing and some other things going on these days. This is data from USDA's on their refrigerated truck dashboard. You see, we had a period of declining prices. Prices are starting to tick up again, especially with the cost of diesel and gasoline. So, it's important data to stay on top of. The extent to which Washington can get their fruit to different parts of the country is very much a factor of what the trucking rates are. And so, the extent to which you have a quote unquote moat around your region is something to keep an eye on with these trucking rates. Labor costs, so they have habitually been our number one cost of production and continue to be, but fortunately there were changes made at the end of last year in the fall of 2025, changing the way the H-2A labor rate is calculated, no longer based on the Farm Labor Survey. They have two tiers, kind of entry level and skilled. They have an adverse compensation adjustment that helps you get to basically a housing discount on that. But all these rates are going to be, for the most part, lower by state. They aren't necessarily as low as the tables would imply, given that some states have minimum or prevailing wages that prevent wages from falling below some threshold. But in general, should be a savings for apple growers out there at a time when they could really use it. So we're going to spend the rest of the presentation going through this chart, and I promise you'll probably be sick of this by the time we're done. But this is a chart that the dark red is the total export movement, and the lighter red is the total domestic movement. These come from the AMS data set that tracks shipments. So the export movement does not match the export data out of USDA, their Foreign Agricultural Service data set. So it won't match exactly with that, but I think it's useful to use this. They come together, categorized differently. Imports are also included, and so it's even if it's not entirely accurate with level, it is at least consistent over time and relates to the total domestic movement that's in the same data set. The domestic grower prices, the yellow line is, I have disaggregated export sales, export pricing from that. The export pricing is typically significantly lower than the domestic pricing, and I want to keep it clean for the sake of this analysis. And it's also been adjusted for inflation. So that's important to keep in mind. All right, so let's start with the period from 2000 to 2015. During that period, total movement sort of increased from the 100 to 110 million bushel range up to the 150, 160 million. This is a stacked area chart. So the sum of both the exports and the domestic movement is total movement. So that's up 42% during this period, not an inconsequential increase. Exports went from 20 to 30 million bushels up to 40 to 50 million bushels. I think 47 million bushels was the high water mark on those exports. And just again to show you the crosswalk, the Foreign Agricultural Service has the high water mark in the same year, but at 52 million bushels. So 47 versus 52. It's it's a little off, but not too bad. And so you have these peaks, surges in production managed with export growth. So you can read these movement data essentially as production or as a supply, and so you've got these. When you have a peak like this, you can read it as a peak in production. And so what you have back in this time frame, 2000 to 2015, you've got corresponding peaks of exports. So what that tells you is that what's going on is you're having surges in production, and so you need an outlet for these apples, and so you turn to your export markets, and you typically use some promotional pricing, and are able to offshore these apples and keep the domestic prices. As you see, the domestic prices are still taking hits, but I think they would take hits significantly more if you didn't have that pressure release relief valve. So what's happening to export pricing? As I mentioned, a little bit of promotional pricing. This is now not domestic pricing on the yellow line. This is export pricing. But with these peaks in exports, you're dragging down the export pricing. But you see it significantly lower, between 20 and 33 bucks a bushel, compared to. I guess I should have done that in boxes as I had the other one. But nevertheless, it's significantly cheaper. And again, the varieties that we're exporting aren't as necessarily as high quality. They're the reds and other varieties, not necessarily the Honeycrisp and the club varieties that we are. So, but I think so this decreases of between 10 and 15% in those year-over-year when we had those domestic or the production surges. In terms of percentage of total movement during this period, exports went from as low as 20% of total movement to 5 consecutive years, right up there around the 30% of movement. I think people got used to that. That started using that number kind of in their head as a nice round number of around a third of the crop is getting exported. And when that's working, that's great. But we'll see what happens when that tap shuts off. During this period, this is now an unstacked bar, so you can see the or unstacked area chart, so you can see how domestic movement, the lighter red's doing. This is 70 to 80 million bushels starting in 2000. So not only that total movement wasn't just driven by exports, there were domestic movement was also increasing during that period. So up 33%. But of course, that was done on promotional pricing as well. So here we get to see the unstacked area chart and what happens with those production peaks and what happens to pricing. So again, the same way we're pulling down export pricing, we're pulling down the domestic pricing, sometimes fairly considerably over multiple years. That's about 10 to 20% year-over-year corrections in those prices. But despite these sort of one-off shocks where we had year-over-year surges in that production, in that movement, prices generally were still on the rise. So we're moving from again, this is inflation adjusted domestic prices, moving from around 25 bucks a box to about 40 bucks a box at our high. That 2012 year, of course, was the year that Michigan lost 90% of their crop to an early bloom and a late frost. So obviously there were opportunities in the marketplace, so maybe that is a little bit of an outlier, but in general, that trend line is pretty strong in the upward direction. So, but what we have, the $40 a box is clearly just an average. If we disaggregate that, again, from the 2000 to 2012 time period, Honeycrisp wasn't tracked until 2008. So we have a fewer data points for that. But As you see in that year, that Michigan crop loss year, 2012, in yellow, Honey Crisps get all the way up to $100 a box in inflation adjusted. So that is a pretty nice return. Maybe it was a little bit trickier to grow them back then, grow them and store them, but still a really healthy incentive to grow to get into the Honeycrisp game back at that time period, up 12% since 2008. In terms of Gala, they got upwards of $50 a box, up 45% from 2000 to 2012. Grannies were also increasing. Fuji's and Grannies around $40 a box. Grannies up 30% over that 12 years. Fuji's up 25%. So everything kind of on the march upwards. Red Delicious getting up to around $30 a box, up 50% during that time period. So what we had during that during those nice salad days of the Apple industry, we had 2015. We had supply growth that was met with demand growth that was accommodated with price growth, and that incentivized additional supply growth. And in addition to that sort of what was going on in the industry, you had super low interest rates. And so, that first acreage chart I showed you where we started plunking in acreage in 2012. Well, that's here on the interest rate chart. You see that those positive returns during that period of rising growing prices and low interest rates really kicked in that acreage growth. The max price was achieved at this point. During this period of interest rates from after the 2013-14 season, you had or the 2012-13 season, you had flattening grower prices, but interest rates stayed low for a while. So we actually continued to put in that acreage, and then sort of COVID shut off the tap on that, fortunately. And that acreage increase started to abate, but a little bit of a bullwhip effect there, where you have continued investment, both incentivized through the low interest rates and to some extent those prices that you remembered when you started putting in the crop, and then starting to flatten out before you're even done putting in all that acreage. And then, we get the interest rates spiking, and of course, that investment stops, but it may be a little bit too late, as we've got a lot of that acreage continuing to come online and produce. So we have some falling growing prices going on right now. So we move to the next period, 2016 to 2023. And for the most part, you're looking at the dark red again. Total movement generally flat, except for that 2012 year, between 140 and 150 million bushels, sort of this plateau. And then the total exports during that time are down 42%. So falling from that high of around 47 million bushels to I guess as low as 27 million bushels, and so decreasing 42% during that period. But the same way we had that surge protection from those corresponding peaks back in as I said, those previous years, including 2015. There's no corresponding peak here in this stack data chart. So you've got the exports continuing to fall, and you've got all these additional apples you need to move, and it falls. The onus falls on the domestic market to sort of soak up that excess capacity. So during this period, we mentioned that we had a nice run of exports being 30% of movement by 2022. with the loss of the Indian market, and some other declines. We were down to exports being only 20% of movement. So we have started to build that back up again. I think it's just a super important mechanism for U.S. apple growers to be able to tap into that when they need to offload additional fruit. So when we say domestic, the total movement was flat, total exports down. This chart, on the this is now unstacked, so you have the true picture of what's going on with domestic movement. Looks flat except for the 2012, except if you realize that with demand or the exports kind of falling away from your feet, that's excess light red there that you need to take care of. So everything in these shaded regions above and below these bars, this is the additional production that needs to be utilized by the domestic markets, and so that has a significant impact on price. Domestic prices were relatively flat, except for that one surge year in 2020, COVID. I don't know if that was bagged apples or a good production year or both, but we did see that decrease down to around $32 a box or something like this during that period. But for the most part, prices were resilient, staying in that narrow band between kind of 32 and 37 bucks a box. We move to now the final segment of the chart. We have 24 to 25, and we have here total movement spikes. This is where all that investment with low interest rates and Honeycrisps at $100 a box, and new acreage and new packing lines and storage facilities and better protocols, and all that technology is coming to the fore, and Mother Nature also comes up aces, and we have two significant production years. So the total movement up 15% from prior years. Now we're at levels of 160. Total exports, they are fortunately able to soak up a little bit. We are able to get them back again through some promotional pricing. I think there was only an 8% drop in year-over-year export prices, and down to an average of about $23.75, $24 a box, or no, a bushel. So some promotional pricing, but not all. I think some of that had to do with the weakness of the dollar and the ability to kind of have a relatively cheaper product overseas, given the fall in the dollar index. So exports now, they're not at 47.50. They're now around 40. Again, we've seen some charts that show us that exports are on the mend, and that's a good sign. So in terms of what happened to domestic prices, this really cratered. So this took us off the plateau. That the first inflection point that I refer to is when we go into the plateau, and then this is the second where we kind of we fall off the cliff. With production at those levels, domestic prices, even with a little bit more exports, they're falling to 23%, to around $28 a box, and we'll look at what $28 a box means in today's marketplace. But here's the rest of the data from by variety. So falling from that around $100 a box from 2012 to 2025. Honeycrisps are now, you had that one bad year last year with a significant amount of Honeycrisp in a big season. So we're back up to around 45.50, but we're going to look at a minute whether or not that's covering costs at that level. The next Galas, Grannies, and Fujis, they're all around 25 to 30 bucks a box, down 42. Again, this is from the high in 2012, down 42% for Gala, down 34, down 31. So prices all, these inflation adjusted prices falling. And then Reds also falling 36% to around 20 bucks a box. So, why is keeping an eye on these, these data important? Well, obviously, each of these varieties has their own production cost of production, and based on a 2024 study from WSU, the break-even point for Honeycrisp is around $40 a box. That's, just basically short-term operating return on investment there, enough to keep the farm going, cover variable costs and that kind of stuff. So with Gala and Granny Smith, the only other two varieties, they didn't cover Fujis and Reds, but they were closer to around 30 bucks a box in terms of cost of production. So you see how those asterisks are above the current pricing. Well, that means those varieties are underwater right now, and so something needs to give, because that is not a sustainable kind of model there. If we break these pricing and sort of the movement and the pricing down into this matrix here, we can start to build some demand curves. So I've grouped 2000 to 2005 together in the dark purple there, and kind of drawn a best fit line. And we get somewhere around 80 million bushels for about 27 a box, and again, inflation adjusted. And so, we were producing at those levels. The market was liking it, was rewarding us with additional demand and increasing pricing. So the demand curve kind of shifted out to the right between 2006 up and to the right, 2006 to 2011. So now we're closer to 87 million bushel production at around 32 bucks a box. We have those outlier years where it's kind of extraordinary circumstances, and these are calendar years. So part of 2013 is part of the 2012 season as well. And so you've got these kind of, production, even with Michigan's loss. I guess Washington or somebody else saw that coming, and they went in for a third pick, and pricing was good. So we still had 90 million bushels selling it for around 39 bucks a box. Then we sort of hit that plateau, and we start to, as I said, the 2012-13 was sort of an outlier. So you can think of skipping the yellow and just going from green to pink there, moving right along, and a little bit of an increase in price during this period. We're producing 110 million bushels for around 35 bucks a box. That's kind of looking like a sweet spot. But then, our production in 24-25 jumps to that 120 million. This is domestic only, domestic movement and domestic price. We kind of hit that 120 million domestic, and the prices, really don't support that. And we dropped to about 28 bucks a box. So, the other important, if we're talking about what is economically sustainable in the short term, I think it's important to note we've already seen some coming discounts on labor for this year and the following years, provided those new AWR rates take effect. But you've got people happily producing back in 2005 at 27 bucks a box. And now they're losing their shirts at 28 bucks a box. And those are, again, inflation adjusted. So what gives? How can you compare, the ability and the willingness to produce at these various pricing? Well, you have to take the costs into account. So, of course, The yellow line here is the inflation-adjusted H2A labor rate for the top 7 Apple states, and we're going from 1550 to 1850. So in a real sense, in an inflation-adjusted sense, labor is getting significantly more expensive. And as a share, so if you just take that hourly share of labor, or the cost of labor, the prices of labor, up 21% during this period, and you take that as a share of an average price per box, those, basically labor, cost of an hour of labor soaked up 40% of your returns back in 2023. But now in 2025, that same hour of labor is soaking up 60 to 70%. So, when you're talking about the prices that are going to keep you in business, obviously, there's the other side of this equation, and if labor is somehow able to get cheaper, maybe we don't need quite so much a box per box. But barring that labor is going to start trending in the other direction considerably and for a long period, I think is not very likely. And so I think just having the cost per bushel or cost per box in mind helps you figure out, yes, these are all high level averages, but what is my farm able to do? How am I able to produce these apples at reasonable costs, given that these are the pricing that I'm receiving, or being able to negotiate at these levels of supply. So those shares up 27 percentage points during that period. And then finally, we're just going to look at how the pricing, this is monthly data instead of annual. So season to date here, we had at the beginning of the year, as I mentioned, we thought we were going to have a lot of Honeycrisps, which is why prices were high in August before the new Honeycrisps came to market, and then started falling precipitously through November, December, and then we realized, we've got that quality issue in Washington. They're not packing out, and so prices started to rebound. So we're still down 22% year to date, but as you can see, those prices have come up considerably since the November, December timeframe, although the first couple data points I have here for April seem to indicate that Honeycrisp prices is slowing a little bit. In fact, they all look like they're tailing off a little bit. But Grannies are down 2% year to date. Goldens, they're doing well, up 26%. Fuji's up 7%. Gala's doing well this year, up 27% year to date, and Reds are also up. So, but this at the end of the day, this is NCREIF data, and I know this only covers 38 properties here. This is from Aegis Capital, the year ending 2025, 4 quarters. So, this is a sample of investment grade Washington properties, 38 of them worth $581 million. The 1 year return on income is now negative compared to all these other crops that pistachios, wine grapes, oranges, almonds. They're all having these 1 year positive returns. But this data confirms what we've been talking about, that I know, again, this isn't nationwide, and maybe this is commercial versus direct to consumer, but these data state that the apple industry is kind of underwater at the moment, and need to figure a way out of it. In terms of capital, 1 year return on capital, we've got nearly negative 9%. Not as bad as wine grapes here, but this number could get worse if we start to have some transactions and start booking some lower valuations on properties that are changing hands during this difficult time. So that could get worse, but not a super encouraging sign. Down over 10% on 1 year. Still 5 year income slightly positive at 1%, but still negative numbers over 5 years. So not the best trend, but we can, I think we can get our way out of it. So 25-26 production down somewhat due to weather and quality issues. Exports starting strong. We have optimism regarding re-upping the USMCA, worth over 50% of our exports to Mexico and Canada. Some potential, more than rumors, some language around India and Taiwan bringing their tariff rates on U.S. apples down, but with everything else that's going on, it's difficult to get clarity on exactly how that's going to impact us and when. 25-26 grower prices are mixed. The new AWERs are going to significantly lower our number one cost, or may, if you take advantage of those. Difficult to do with the crew you've had back year after year, to give them a year-over-year pay cut, but at least on the new guys, you might be able to realize some savings. So again, these are sort of the benchmarks. Your own costs are going to play into these extremely, they're going to be exactly what you need to look at to determine what your break-even points are. But we have this trajectory. 2000 to 2015, enjoyed a positive feedback loop. 90 million bushels at around $40 a box was the peak there. 15 to 23, plateau tested limits of domestic demand. So we were at around 145 million bushels for 35 bucks a box. And then we hit 160 to 23, 25. I guess it would be 24, 25. Downturn exceeded total demand at 160 million bushels for 30 bucks a box. So, that's kind of, again, big round numbers, but it's I think where we need to be thinking as an industry when we're needing to show discipline around harvest, or whether it's the varieties we keep in the ground, it's the quality of the stuff we're picking. If we can move the needle on domestic health messaging and get additional domestic demand, if we can, get back market share and increase our exports, I think we'll be in good shape, and basically hopefully find our way out of this without too much loss of acreage, loss of farms, and loss of production. So I'll put in a pitch for the Outlook conference in August. Again, great content, and if you want to be in the room while we're deciding kind of how to adjust the USDA number, important place to be. And I'll also put in an informal pitch for USApple webinar later on this afternoon on weather. So if you're worried about early bloom and late season frost, we over at USApple's channel we have a webinar today at 3 o'clock Eastern time. So with that, I'll wrap it up and see if there are any questions.
Yeah, Chris, we got a couple questions from the audience. First one asks, what does movement overall indicate?
It's shipments. So in the data set they'll have the origin of the movement, so you can tell, is this Yakima or Appalachia district, or yeah, they are basically, it's not survey data, it's actual shipment data, and they've got market news outlets across the country, a dozen or more, that roll this data into USDA AMS.
Another one here, this is a longer question. But according to most inflation calculators, $27 in 2005 would be worth $45 today. So we are overproducing as a country, considering that pricing has not moved in line with inflation. It seems the market is way oversaturated. How much volume change does there need to be to right the ship and be able to have retailers adjust pricing to get closer to the inflation adjusted number? Are we at a point where there needs to be massive reduction in acreage, or we risk being viewed more like a commodity, or more as a commodity like corn? There's a couple questions in there, but
Yeah. Well, okay. So I mean, all these prices are inflation adjusted, and so again, it's about what your cost of production is. If you can, and again, these are all averages. It's going to differ by variety, but I think from the WSU study, $28 a box, which is the average when we were producing domestically for domestic markets, 120 million bushels. To move that volume, the average price dipped below $30, which was the break-even point used in the WSU analysis for 2024 for grannies and galas. Now there might be some people that can do business at that level, and some people, that can't. That might be an average break-even point as well. But that seemed to be, at least where we were here. When we were down 10 million bushels lower, we have, outliers where we had, still 120 million production and had a higher price. But this cluster looks a little bit more doable at 110 million bushels and $35 a box. That is not covering, that average is not covering your Honeycrisp's cost of production at 40, but it is covering your gala and granny cost of production. So, this isn't meant to say that this is how much acreage needs to come out, or how much production needs to be down. But I am just showing you where this data, if we can shift total movement back to the left here, we may be able to get back on this demand curve. Hopefully, we don't just produce less and continue to sell it for the same amount. But I don't think it works like that. So, I don't have a prescription for exactly how much less, but and it's all relative to what your cost of production are, what you need to make to make this pay. But something like this, I think, seems a little bit more sustainable than something down here.
Another one here related to fuel costs. So you had the slide with how much percentage labor was per box. Someone's asking if you have the numbers of fuel. So how much fuel cost goes into a bushel? Do you have those numbers? What percentage of?
Yeah, and this isn't exactly how much. This isn't exactly how much labor costs per box. This is just taking the hourly labor rate and saying it's a way of normalizing this, so we can just sort of see what an hour of labor is in terms of the cost of the box. It's certainly not just 30% or 40%. Even back then, it was significantly more. It's closer to 2/3. But I do not have the analysis of fuel cost or the percentage of fuel cost per box. I do know that it's going up, and there may be some folks in Middle America that typically get shipments of Washington fruit that they might get a few less shipments of Washington fruit this year, given the pricing of fuel right now. So we talk about industry wide, it's going to increase everyone's cost of production, certainly, but it may protect some of the folks outside of Washington that you don't want. They don't want the apples getting there as cheaply as they have in years past. So.
Another one here. How do you get the average price per box? Do you adjust for Honeycrisp influence, or is it just a straight average?
It's just a straight average. So yeah, there's a lot of data. I use, there's a couple hundred shipment transactions per month over all these months, and so they, just basically, I can get it with or without Honeycrisp. But yeah, my pricing, unless I've disaggregated as I've shown you here, all the pricing I've shown includes Honeycrisp. But as I said, it does not. The majority of the charts I was showing you were not. They were domestic prices, not export prices. So I didn't want, given that export pricing is typically significantly lower than domestic, I didn't want to muddy those waters. So this is just kind of what to keep your eye on with respect to domestic pricing.
Another question here. We have more varieties in the East. Is this good or does it hurt us?
I think that being able to tap into having a wider variety, being able to tap into farm stands and UPIC, and not having to race to the bottom to compete for some of these big retailer contracts is actually something that would help you in these times. Those a lot of the growers in that space are actually growing at this point. They're expanding their operations because of, just it's such a wholesome activity. It depends on location. You need to be near population centers, et cetera. But I think people are increasingly quitting the wholesale game and finding out that you can still grow apples and pass the farm on to the next generation without trying to compete yourself into being able to sell $28 a box apples. So again, it's location dependent, but I would say having those varieties, having those direct to consumer outlets would be a great thing.
Okay, those are all the questions we have. So I just want to say thank you, Kyler, and thank you, Chris, for presenting. And just a reminder that Chris's presentation materials and a recording of this webinar will be available at farmcrediteast.com. And thank you all for attending and have a great day.
Thanks.